Welcome to our fourth quarter market update. We appreciate everyone making time to join us today. It's been an active year of enormous amounts of change, not only in the world, but in the markets. And today we're going to go through a quick recap of the third quarter, but also looking forward to the end of the year and then a little bit into 2026. Today I'm joined with Pat Donlin. Pat, are you there?
Austin, great to be here.
Great. We're going to pursue the format that we've done in the past. I'm going to hand it over to Pat to maybe go through some of his initial thoughts with a few slides. And then at the conclusion of that, Pat and I will go through some additional questions that have surfaced and also a little bit of perspective on going forward. So with that, let me turn it over to Pat. Pat?
All right, thank you, Austin. So we'll start with the review of third quarter returns. It was another strong quarter across all asset classes. So equities continued to rally off of their April lows. Emerging markets were the top performing asset class in the third quarter. That was really an artificial intelligence story. So Chinese equities led the way. They've actually got their own version of the Mag 7 that's being called the China Tech 8, which is not as catchy of a name, but up 25% this quarter. And then Taiwan Semiconductor, which is a semiconductor manufacturing firm, it's the largest name in the MSCI Emerging Markets Index. That was up over 20% in the quarter. Then US small cap, actually second best performing asset class this quarter. Small caps finally notched new all-time highs in September. They had been basically flat coming into the quarter on the year. And then US large and mid cap, another strong quarter. As you move down to fixed income, it was a clip the coupon type of quarter for fixed income. We did see rates fall marginally across the yield curve and credit spreads tightened about 10 to 20 basis points. And then if we go to the year-to-date returns, on the year, it's been non-US equities leading the way. So EM now has pulled ahead, the best performing asset class year to date, but developed international right behind it, up over 25%. The MSCI EFA index is off to its second best start in the last 25 years. So just a really strong year, really across all asset classes. And what's driving this? We think there's really two key variables that help explain the asset class returns we've seen this year. And the first one's real rates. So we're showing here the real 10-year Treasury yield, meaning the inflation-adjusted 10-year Treasury yield. That's fallen about 40 basis points this year. And that's supportive for equity multiples. We typically compare an equity risk premium or equity PE ratio relative to real rates, specifically the 10-year real rate. And then the second factor is the dollar. As I mentioned previously, it's been a tailwind for non-US equities, developed markets in particular. We're showing here the US dollar index, or the DXY index. That's measuring the dollar relative to 6 other developed market currencies. So that directly translates into higher returns for non-US equities, which are priced in other currencies. But it also actually can be a positive for US stocks and large caps in particular, because many companies derive a significant portion of their revenue from overseas. So we think those are two of the key factors affecting markets this year. And why are those two variables falling? Well, we think what's happening at the Fed has a lot to do with it. And there's a lot to unpack on the Fed topic. We spent a lot of time in our Outlook letter talking about this, so I won't cover everything here. But the short version is at the beginning of August, one of the Fed governors unexpectedly resigned, and that left a vacancy at the FOMC, the Federal Open Markets Committee. President Trump appointed Stephen Miron to fill that seat. And that name may sound familiar to many of you. He's the chair of the Council of Economic Advisors, and we've talked about him several times this year due to a paper he had published last fall about the global trading system and tariffs and how they can be helpful to achieve that goal. But in that same paper, Miron also talks about the Fed playing a crucial role in achieving certain policy objectives, like controlling long-term interest rates. Uh, so Myron's appointment certainly caught our attention. I think the attention of a lot of investors, and you pair that with President Trump's attempt to fire another Fed governor, Lisa Cook, public pressure for Powell to resign back in July. And we think this narrative of Fed independence being under attack kind of took shape. And the implications of the Fed potentially losing its independence would be possibly higher inflation, lower rates, money printing, all things that would weaken the dollar and potentially cause a bubble in financial assets. So we think, looking at the dollar and real 10-year yields, the market may be pricing in this type of scenario, the Fed losing its independence. So back to Myron. So what we're showing here is the Fed dot plot. So there are 19 members of the Federal Open Markets Committee, the FOMC. 12 of those members actually get to vote on where to set the Fed funds rate. But they all get to give a projection for where they think the policy rate will be at the end of this year, at the end of 2026, at the end of 2027. So those projections are published here in what's called the dot plot. So each dot represents one of the 19 FOMC members. And we're showing here there's a pretty clear outlier in 2025. The median dot had projected 2 more rate cuts for this year. And then one member of the FOMC, who we now know is Stephen Myron, projected 5 more rate cuts for this year. So certainly didn't help dispel the idea of the Fed losing their independence. Even Myron's pushing is that large of an outlier. But to be fair to Myron, he did address after the reasons for why he projected policy rates to be cut so aggressively. And one of the big reasons he cited is the lag in the CPI shelter component. And we're sympathetic to that view because we've published this same chart earlier this year in the end of last year, showing CPI shelter lags more real-time indices like the Zillow Rent Index, for example, by anywhere between 12 and 15 months. And so earlier this year, we had shown this chart and said, we think the Fed actually has more room to cut than the market is currently pricing in, because we know this shelter component, this dark blue line, is going to come down to meet that light blue line. And even today, the CPI shelter component is about 100 basis points above the Zillow Rent Index. And shelter is almost a third of the CPI. So if they used a real-time metric there, that would actually have a pretty significant impact on the headline inflation number. So even though Myron was an outlier to the downside as far as policy rate projections, it's pretty clear from that dot plot slide that the direction of travel for the Fed funds rate is lower. And the Fed chair, Jerome Powell, actually had even recently remarked that he's now more focused on the downside risk to the labor market than he is on inflation, even though that's still running almost a point above the Fed's target 2%. So the labor market is really tough to read right now. We've had a couple very disappointing non-farm payroll numbers showing we only added 20,000 workers in August, for example, when hundreds of thousands of jobs were expected to be added. Now, what we're showing here is we're in what's being called a low hire, low fire environment, where job openings are down about 30% from their 2022 peak. But on the other hand, initial jobless claims are pretty contained. So they've been basically flat for the last 2 years now, and they're below their pre-pandemic average. So companies aren't necessarily looking to hire, but they're also not laying off many workers. And so it's creating kind of 2 distinct realities where those who have jobs are likely to keep them, and those who don't have jobs are facing a pretty difficult market. And it's hard to get hired right now. We're not creating a lot of new jobs. And so if you got stagnant payroll growth, the question is, how do you keep GDP growing? And one way would be increased productivity, meaning the same number of workers can produce more output, or fewer workers are needed to produce the same level of output. And the hope is that we're going to get higher productivity from artificial intelligence. Um, and if we look at here, the Atlanta Fed GDP now, they're forecasting for the third quarter almost 3.5% real growth. And the contribution from business fixed investment, which encapsulates CapEx, a lot of which is to build AI data centers, accounts for about 75 basis points of that 3.5, or about 20% of the total expected growth. So the AI data center boom is not only, hopefully we get productivity benefits on the back end from AI applications. On the front end is also the build out of these data centers is a meaningful contributor to GDP growth. If we look at the market, AI has also been a very big driver of market valuations here in the United States. We mentioned China earlier. Um, this is the S&P 500 forward PE ratio relative to its historical 30-year average. We can see here we're over one standard deviation expensive relative to the historical average. Today's PE ratio has only been exceeded by the dot-com bubble, which you never like to be compared to. But we would draw a distinction between today and the dot-com bubble, that if you look at the last year of the dot-com bubble from 99 to 2000, all of the market return was driven by multiple expansion. So earnings growth had already turned over and was on a downward trend, and multiples continued to expand. And today, that's not the case. So the Mag 7 companies, all of which have some tie to AI, have grown to be a larger piece of the index. It's about 35% of the index today. But their forward PE as a group is actually flat on the year. It's exactly where it started the year. So the returns this year have been actual earnings growth and then projected earnings growth, but it hasn't been multiple expansion. As those companies have grown their earnings, they've become a larger weight in the index, and that's driving up the overall index valuation. But those companies are, they earn very high returns on equity that generate very high levels of free cash flow, high net margins. And so while valuations in the index are certainly high, no denying that, the fundamentals of the companies at the top of the index are much stronger today than they were back in 2000. And then I'd close with fixed income, and specifically want to take a look at muni bonds. And so if you're thinking, what can I buy that's not at an all-time high valuation? We think munis, and especially longer duration munis, offer really attractive returns today. So if we look at where we started the year, it's a yield curve, treasury yield curve, muni yield curve at the start of the year. And treasury rates have come down across the yield curve, across all maturities, more so at the front end, but rates are down across the curve. In munis, it's not the case. Rates have come down at the short end of the yield curve, but the long end of the yield curve is actually higher today than it was at the start of the year. We think that has mostly to do with technical reasons, but it's created this really attractive opportunity for investors to lock in higher yields for longer. And munis just look very attractive, certainly relative to treasuries. That's one area of the market that we found good value, that you don't have to get in at all-time high prices. And in fact, you're getting yields that are some of the highest we've seen in the last 20 years. And so those are some of the key movements in the markets and the economy. Back to you, Austin, for Q&A.
Thank you, Pat, and thank you for that overview. Why don't we go a deep dive into a couple questions here, and let me start off with one. Specifically, we've had 3 really strong years in equities, and currently valuations are quite, I'd say, relatively high. And so the question, Pat, that I'd love to hear your thoughts and perspectives on is, talk to me a little bit about how you would see earnings unfolding here in the first days of the fourth quarter, but more importantly, your expectations for earnings growth through 2026.
Sure. Yeah. So earnings season, Q3 earnings season kicking off really in earnest next week. The market's looking for about 8% earnings growth for the S&P 500. We think that number ultimately will end up around 10 if the typical 2 to 3% surprise, earnings surprise happens. I think tech and the Mag 7 are going to be big drivers of earnings this quarter and in the fourth quarter. But as you look to next year, into 2026, we're really starting to see a broadening out of earnings. So the last few years, it's been Mag 7 really carrying the index, the only place you could find earnings growth. Next year, we actually think small caps are going to have the strongest earnings growth, almost 18%. Mag 7 still very strong, but the S&P X Mag 7 only about 1% behind the Mag 7. EM expected to have strong earnings, developed international. So really, across any dimension you can look at by sector, by market cap, by region, we expect a broadening out of earnings next year. So I think it's good news for investors looking to diversify away maybe from those Mag 7 names that are at ultra high valuations.
So, Pat, I take from your comments a relatively maybe a cautiously optimistic perspective going forward. And so, talk to me, and I have to say that gets me a little concerned, and maybe many of the viewers concerned to the standpoint of this will be potentially 2025 here, a third great year or above average year, I guess, in the markets.
Mhm.
I'm hearing mixed comments around how we think about the economy as a whole, particularly around the labor market and maybe different sectors of the consumer base. What do you have any concerns regarding recessions or something that actually would trigger a different scenario?
Uh, we we do. I mean, I'd say the higher probability risk is high inflation. Maybe not runaway inflation, 70s, 80s type inflation, but higher than usual inflation, maybe negative real wage growth, which would really weigh on the economy. Uh, but there are a couple indicators we're closely monitoring that certainly have caught our attention. One of which is the unemployment rate of recent college graduates. And so if you look at, so we're measuring recent college graduates, those with a bachelor's degree, age 22 to 27. And if you look at the unemployment rate there relative to all workers, it's not a huge gap, but it is increasing at a faster clip than the unemployment rate for all workers. And it's the first time in the history of the data set, we've got the data going back to 1990, that the unemployment rate for recent college grads is durably above. It's been a couple years, 3 years now. It's been durably above the unemployment rate for all workers. And it could be a lot of factors weighing into that. It's a volatile data series for sure. We only have the data through June 30th. Tariffs were still obviously top of mind at the time. Companies may have been holding off on hiring. But we do think maybe AI is starting to play a role here and that companies are holding off on hiring workers and specifically younger workers while they wait to see how the AI story plays out and if maybe they can maybe they don't need to hire as many workers, frankly, as they have in the past. So I'm not AI doomer by any respect. Don't think robots are going to take all of our jobs, but there could be this painful transition period where unemployment runs above historical average as companies decide they don't need as many workers. And then related to that, I mentioned earlier, the AI data center build out has been a significant piece of GDP growth this year. And to the extent that spending turns out to be unprofitable and the hyperscaler, Meta, Microsoft, Google, Amazon, Oracle, except they pull back on that spending, that can have a pretty big impact on economic growth because there's a multiplier effect to that spending. It touches a lot of different industries, real estate, obviously semiconductor manufacturing, construction, industrials, energy, utilities. So we'll definitely be paying close attention to what the hyperscalers say in their Q3 earnings call about their spending plans for next year.
Pat, should I interpret your comments as that a recession or weakness in the economy is much more maybe specific to certain populations, certain segments, certain geographies, rather than a broad scale? Is that how one might interpret the comments? So again, recent college grads is one population. I think
Mhm.
I recently read something, 20 out of the 52 states are, I'm sorry, 20 out of the 50 states happen to be in a recession if you factor them individually. Is
Mhm.
that how we should think about it? And again, Meg 7 sort of dwarfs so many of those.
No, I think that's it. I think when you try to square what we see in some of the consumer sentiment data, which is near pandemic lows, the consumer outlook for the economy, and try to square that with the aggregate consumer spending data, those two things don't seem to line up. That consumers are dining out, they're traveling, and yet they're saying their outlook for the economy is quite pessimistic. And I think it's because there's a small portion of the population that accounts for such an outsized portion of consumer spending. And that cohort is doing just fine. And they weren't impacted by higher interest rates. And there's a lower income segment that's getting crushed by higher interest rates. And the good news for them is we do think rates are coming down. That should provide some relief. Lower oil prices should provide some relief. Um, but yeah, I think you're right. I think we've been in this kind of two-speed economy, and I mentioned earlier that if you don't have a job today, we showed initial claims earlier. If we were to look at continuing jobless claims, those are creeping up, even though firings are pretty well contained. Once you get fired, it's pretty difficult to find a job right now, and people out of work are staying out of work longer.
Oh, well, that's helpful to clarify. I guess my final question somewhat relates to this, which is the standpoint of the concentration of so much economic, focus and capital and newsprint, specifically around one company, NVIDIA. And again, this is a company that many people, I would say 10 years ago or so forth, just not on the radar screen. Today, I believe it has the same capitalization as the British economy or something along those lines.
Right.
Um, Talk to us about how it sways the market and how you interpret its how it goes versus the broader market today.
Hmm. Yeah, sure. So it's now about 8% of the S&P 500 index, $4 trillion market cap company. Uh, and I think there's a very wide range of outcomes for NVIDIA. And we thought that one interesting chart to show, we referenced this in the Outlook piece that we wrote, uh, just to try to quantify. So, it's difficult. Is there going to be another DeepSeek moment that some Chinese company comes out with a better large language model that's more efficient and reduces the need for GPUs? Will there be custom silicone that will reduce the need for GPUs? Yeah, it's tough to say, but without even getting into that, if we just look at it from a market efficiency perspective, so if you believe markets are efficient or at least semi-efficient, and the only way that you can earn outsized returns in the market is to find something that's not already priced in, or a low probability event that actually occurs. And if we go back to NVIDIA, when they started their incredible run, really right after ChatGPT was released, and we look at their successive earnings beats over that time, it is amazing to see just how wildly underestimating the company that the sell side was. So we have a great chart here. The light blue bars are what you typically see reported. So let's focus on the second quarter of 2024. NVIDIA beats earnings by 31%. That's the headline. And it's true, but that's the analyst estimate from the day they reported earnings. If you went back to the first day of that quarter through the last day of the quarter, analysts increased their estimates by 95% over the span of the quarter. So the real beat was actually something more like 150%, not 30%. Now, and if you use the cumulative beats that the company has had, that actually lines up pretty closely with how much the company has outperformed the S&P 500 over this time period. Uh, and what we notice on this chart is the analyst revisions during the quarter are getting smaller and smaller and smaller, almost negligible at this point. And the beats are around 2 to 3% the last couple of quarters, which is right in line with the average for the S&P 500. And so that's not to say NVIDIA doesn't have very strong growth ahead of them. They're priced for 50% earnings next year, 40% 2027. But it's priced. It seems that analysts have finally caught up to the stock. They've got a better handle on it. And even if they deliver that growth, you're not going to see the outsized returns relative to the rest of the market that you have over the last 5 years. And so our take there is just to say, it's 8% of the index. The last really 5 years, excluding 2022, you really couldn't afford to be underweight NVIDIA, or if you were, you underperformed. And we think you can be underweight NVIDIA by a couple percent going forward, and it's not going to kill you. They're going to be more like a market type performer going forward.
Wow. No, Pat, it's your chart is very interesting in the standpoint of a company that people didn't necessarily know how to value. Obviously, your point being much greater awareness and obviously following it, but still a major market mover, at least for the foreseeable future.
Absolutely, yeah. As NVIDIA goes, the index will go to some extent.
Excellent. Well, Pat, thank you. Thank you for your insights here today, and thanks to our whole investment team and for their work that continues to inform how we manage our clients' portfolios. I'd also have to say, if you have any questions or follow-ups on this, please reach out to your fiduciary investment officer or Sid Queller, our head of wealth management, and his slide will follow this. But let me first just thank you all for joining us today. And we look forward to seeing you in our first quarter kickoff in a few months. But again, active times, and we appreciate everybody for joining us today. Thank you.
I encourage you to access some of our knowledge through insights on our website, fidtrustco.com, as well as by reaching out to your fiduciary trust officer or to Sid Queller at 617-292-6799 or at queller@fiduciary-trust.com. Thank you again for joining us, and we wish you and your family health and well-being.
The opinions expressed in this material are as of the date issued and subject to change at any time. They discuss general market conditions and trends and should not be construed as investment advice. Any reference to specific securities are for illustrative purposes only and are not intended to be and should not be interpreted as recommendations to purchase or sell such securities. Nothing contained herein is intended to constitute investment, legal, tax, or accounting advice, and you should discuss any proposed arrangement or transaction with your investment, legal, or tax advisor. Copyright Fiduciary Trust Company.